think just about the purpose of property versus trading webinar. Property versus trading purpose is to introduce you to the two asset classes of diversification to minimize your risk and increase your returns. For traders, it is to know one additional asset class that they can put their money to work further, and for property investors to learn an additional passive cash flow stream. Today's speaker is Dr. Marttand Patel. Dr. Marttand Patel is a highly experienced professional property investor, business leader, and entrepreneur with 25 years of experience. He has started 3 separate businesses in different industries: fashion, solar energy, finance, and derivatives, as well as trading and property, reaching multi-million pound turnovers. He now provides mentoring and coaching in property and business too. Dr. Marttand, it's a great pleasure to welcome you onto Property versus Trading webinar today. How are you today?
I'm fine if you can hear me.
All right. Yes, so now we can hear you loud and clear. I'm sure
Okay.
all the participants will agree with that. They can hear you all good.
Yep, good.
Okay, so let's get into it. Just a little bit about you so that everybody can understand you as well, a little bit, just about how you all started and everything. So how old were you when you started? What event triggered your interest? Do you do other things along with property, or do you do it full time?
I'm a full-time property investor.
Okay.
Right. So, yeah, I run a small business as well, but it's 100% property basically.
And how old were you when you started? What like really triggered your interest to get into this world?
Okay, the property world, it was really working in fashion. Now, I know you've got a lot of traders out there. The main thing is, when you're accumulating wealth through your trading, or it could be even your business. A lot of business owners then want to invest that money. So it was really during the textile period where people were actually beginning to invest. So it was in the 90s, late 80s, early 90s. And it was really to first of all, at that time, I was only 25 or 24. It was more of a case of getting myself on the property ladder as well. But I had the full-time business, which I was working on totally. So, and then one thing led to another, and it was more of a case of, investing the money that I'd already made in textiles into property as well.
Interesting. And how old were you when you started, Doctor? Was it about 20, 25?
24, 25.
Very good. Interesting, isn't it? It's like, I think every interview that we do, I mean, with traders or property investors like yourself, it's really interesting when you look back at your life and see how all the dots actually connect together to bring you to where you are today. It really makes you see how there's an intelligent orchestrator who's actually orchestrating all this string of life events. Now, going on further in terms of your style and everything, you see, for example, in trading, we have different types of traders, position traders, swing traders, intraday scalpers. Similarly, in property, we have different types too, like flipping, buy and hold for yield and capital appreciation, and so many more. So in respective to that, what is your main style of property investment?
Right, I do them all.
Okay.
Look, when you're a seasoned property investor, our job, just like in trading, right? Because I'm also a trader, is to make money. Simple. The bottom line is to make money. We have different aspects to the property. So first of all, it was to create a passive income. And then it was a case of, you'll find that most successful property entrepreneurs will go into property as an investment vehicle. If they don't have much money, they'll look to flip to create some wealth. But generally, as a business owner, and if you're a trader, you've already created some sort of wealth and you're building up that capital. So for me, we have long-term holds, which we've always had. So we look at developments as well. Now it's a case of, we don't add that much to the portfolio. It's more a case of doing developments and flips. So that's, but we cover all aspects, depending on what the time frame is at the moment and depending on what the markets are doing.
Is there like a preference that you have?
For me,
Yeah.
no, I don't. I enjoy all aspects of it. I particularly enjoy the development side and and flipping. Main reason is because you actually use your creativity more. Because at the end of the day, you're building something. You're building a brand new shell basically, and you're putting your own design elements of it. So we are very in tune with design elements, obviously keeping it energy efficient, because I've been in solar as well, and putting, so the main thing is really luxury developments, which is what I enjoy.
And what did you first, when you first entered the property world, what did you first start off as? Just for yield purposes? It's for passive cash flow?
Yeah, no, I mean, just to give you a quick rundown, if you've got lots of traders there. One of the main things in trading is you can make a lot of money and you can lose a lot of money. So, how I started, I had already had some properties, but Northern Rock came along, and basically I had full leverage, full margin on Northern Rock. And I lost it all basically. And then it was a case of when I started the next business, because I didn't go personally bankrupt, but it was really starting afresh again. And I was interested in, at that time, solar energy. And my wife had been harping on about me actually starting a new business rather than just trading all the time. And then from solar, I went on to, once I developed that solar company, and like I said, within a time frame of a year and a half, we'd got to 2 million turnover. But that really also, it's understanding what the market was doing at that time. We were in a recession, but lots of people had money, but they weren't getting a return. And luckily, the government had a good subsidy on solar, and it made the business climb very quickly. Once they started cutting back the subsidy, business became more difficult. And what I wanted to do was really safeguard my family and my future. So how I went back into property was to actually safeguard my family by creating a passive income constantly that's there. So we've got constant passive income coming in. And that was the main purpose of going back into property, basically.
Right. So when you went back in, you were focusing first in the yield kind of style
Yeah.
of
So what we
investment,
were
right?
doing,
Rentals.
we focused more on ROI.
Right.
And it was a case of doing doing the type of projects that you purchase a property and then you refinance it, and basically you've left very little money in the deal.
Okay, great
So
stuff. Okay. Now, going a bit more in detail, like in just like in our trader stock interviews that we do, we usually ask the traders on how they enter into their trade setup. So, for example, in financial market trading, we either look to enter a market either a retracement when it's going down to capture a turning point, or when it's back in momentum, whenever we see some confidence coming back into the market. If we were to cross transfer that into property, how do you guys do it in your property investments? Is it more like value investing where you're buying below market value, or usually referred to as BMV? Or are you looking at more on yield? Is that like a concept to all the property investments that you take?
yeah, the bottom line you've got to remember is making money, right? That is the bottom line. So I don't have, when you say enter a particular property, when I look at it, I look at it, if I'm adding to my portfolio, it is actually adding value. So if I do the work, no one wants to work for free, no one wants to do things for free. So if I am looking at a property, am I able to purchase that property below the current market value, then add value to it? So most of the properties that we do, 99.9%, are all very distressed type properties. So it's actually turning around a distressed property, adding value to it, and then refinancing that property if you want to keep it. Or if you want to flip it, then it's a case of then flipping it. It very much depends on what you're doing at that stage in your cycle, basically. You'll find that most professional property investors, what they have is that they stick to their core passive income properties, which is great. That pays their way. And then after that, they may go into development or flipping, right? So it very much depends on where you are in that particular cycle.
Okay, good stuff. Just a little bit on the BMV. Like, what kind of percentage do you usually look for? Is it like 20%, 30%? What is it usually on average?
Yeah, the main thing is, look, when you're first starting out, depending on how big your pot is, most people when they're first starting out, their pot is quite small. So you would always look for a BMV deal or where you can add value. So you're looking for a distressed property where it's below market. But so just to give you an example, let's say if the done up value of a property is 100,000, let's just work on round numbers, right? The
Yeah.
100,000. Now, if I'm looking to actually draw out all my funds out of that and have no money into that property after I refinanced it, what I would do is I would work on, okay, it needs to be £75,000. The end value has to be, not the end value, but once remortgaged, it has to hit the 75,000. Then I would take away what it's cost me to refurbish it. So let's say hypothetically, it's cost me, I don't know, let's say 15,000. To actually refurbish it. What I would then do is make an offer of 60,000. Do you understand how that would work? Then if I'm purchasing it for 60,000, I'm doing the works for it for 15,000. I'm now reevaluating the property at 100,000. So when I do a 75-25 split, what's happening is that I'm getting the money that I put in back out.
So usually, doctor, if I get this right, and for the participants listening in, usually if a property is valued 100K, I mean, your first step is to get it at least 25% below market value. Is that right?
Yeah, correct.
Okay.
If you're a newbie, look, let me just, it very much depends on where you are in the market, in the property market cycle, right? So if you're in an upward cycle, which we're not at the moment, if you're in an upward cycle, it would be more difficult to get maybe a 25% discount off that
Okay.
property,
Okay.
right? So it could also be that someone who has a pot of £1 million, right, and it's just got sitting there in cash. If you're going to bat your head against a brick wall trying to find a 25% below market, you don't really want to do that. What you want to do is you want to utilize your cash to work harder for you. So it very much depends on individual circumstances. And that's what we do at Infinity Wealth. Everyone is different. Some people start with a smaller pot, some people have bigger pots.
Okay, got you. Yeah, that's
I
really
mean, I
good.
can show you a slide of, if you think it will be useful, I can show you a slide of stuff that we did in 2012, just to give you an idea of, you're talking about what do you look for. And this is what I would say to your traders at the moment, right? It depends on how much money that they've got to play with. If they've got millions to play with, then don't necessarily look for a 25%, below market deal. Even if you get it 10%, what then you should be looking at is ROI and also yield.
Got you. I think it's just the math's got to work. It's the same thing how
Exactly.
we price up a trade to get in. I understand. I'm
Yeah.
sure we'll come to the slides very soon as we go in deeper into the questions. Second thing I want to ask is, doctors, for example, when you buy your properties, do you look into the individual property in question, or do you also look in line with the overall market conditions as well? I think you answered a little bit about that. Like you said, you also look at the upward market and it's tough to get 25%
Yeah.
BMV, and downward market is easier. So do you actually look at that? For example, now we got a COVID-19 as well. So do you look
Yeah.
at overall market conditions too?
Yeah, you have to. Very much depends on it. Again, once again, you're always looking at where you are in the property cycle. If you're going to be doing a flip, you purchase flips and developments at the bottom of the cycle. Or once that cycle is turning up, right? That's when if the cycle is fully going on, then you can do the developments as well. So it very much depends on where you are in that cycle.
Okay, good. Yeah, I guess this thing of cycles and markets, I mean, whatever that the books, the Ray Dalios, the Jim Rickards of the
Yeah,
world, whatever
yeah,
that you listen to and you hear, you always hear all of them talking about at least understanding the basic market cycle and
yeah.
which part we are in. And I think you are reinstating that fact. And I think that's why for everyone listening in, I mean, any kind of market basic understanding is always essential, and that is what I always will tell everyone. Going on to the next point, it's Is there a best property investment that you've done to date so far? And how would you classify best? Would it be best lesson learned or highest yield or capital earned?
No, I think it's a combination of things, ones that I've enjoyed, first of all, and that, obviously at the end of the day, it's the bottom line, how much profit you've made as well. Now, when I was, like I said, in 2012, I've got some great examples, in 2012. All right. Another reason why I've been able to pick up those deals was because I was patient. And I knew where we were in that cycle, because everyone was very against property. There was a financial crisis going on. There wasn't much money floating around. So you could pick up those sort of deals. Now, just to give you an example, I have slides if you need me to show them, but just to give you an example, okay? So we did 3 in a row at the same time. They were in different locations. We picked up one at 75,000 or 72,000. We converted that into a 5-bed HMO, spent about 19 grand on that, converted that into a 5-bed HMO, refinanced that 135, so pulled out all our money from that. Then after that, what we did was that was a student HMO. We then got free cash flow from that one at that time, around about 1,500 per month.
Okay.
There was another example where, and this was in an auction where...
And sorry, Dom, when was this, by the way?
2012.
2012, okay.
Yeah, I'm giving you examples. The reason why I'm giving you examples of 2012 is because, we are anticipating that type of 2012 event, basically.
Got you.
Yeah.
Okay.
So, I mean, I was just going to add, so again, in 2012, these deals come along, these deals actually come along when you're patient and you've got the right things in the market. So just to give you an example, same period, I picked up a real steal in the Allsops auction at the time. It was a block of flats. The guy had been repossessed. These block of flats basically were almost complete. They hadn't been signed off, but they're almost complete. Now, that particular deal I picked up, I was the only guy who put his hand up in the auction. I picked that up 200,000. Right, pick that up for 200,000, refinance that later on for 360,000.
Right. Okay. That means you've really done up the value really very well.
Yeah, and the thing is, and then you would say, well, why would you sell stuff that you've got there? We don't. What we tend to do is we don't keep refinancing. Right. What we tend to do is our initial model was to actually buy below market, add value, refinance to pull all your money out of it, then buy the next one, buy the next one, buy the next one. Yeah. Once you've got a string of these, you've just got passive income.
Got you. Okay. Yeah. Understand. Right. Now, going on to the next one. So that was a really good one where you did. I mean, the block of flats, and you bought 200, you refinanced it for 360, pulled out your cash. And that was also towards rental yields, and you were getting free cash flow from that. Yeah.
Absolutely.
Right. Good ones. And how long do you think is the time interval between you finding one to another? And like you say, you need a lot of patience, just like in the market. So.
Yes. What's funny is that, you could be hunting around for a deal and there's hardly any deals, and they seem to be like buses sometimes. They'll come 3 in a row, and we'll do all 3 in a row. Whatever is there, if it's a very, very good deal, we'll always do it. So it is a case of doing the right type of deal that works for our model.
Interesting. The word patience always goes through any kind of profession and field of investment that you're in. And I think it's very key, especially in trading. You got to keep waiting and waiting for the good ones, even though your hands may be itching to place the trade. I'm sure it's the same in property investment too. What's the longest that you've waited, or have you made some wrong decisions due to impatience as well?
What, wrong purchases?
Yeah, wrong purchases. Yeah, where the numbers didn't work and you regretted maybe later on.
No.
All right, that's
Simple
good.
answer is no.
Right.
Yeah, everyone has made mistakes, but I've never made those sort of mistakes.
Okay, that's very good. That means you've managed your emotions very well. Now, the next thing is, in a recession, This is a usual one that we usually have, and I'm sure a lot of people have these doubts on. In a recession, let's see how you handle this. In a recession, banks usually stop lending or get very strict.
Yeah.
We usually tell our trader clients to make the money off shorting the markets and put in the property as a down payment to get their lending. Do you have any other suggestions?
Sorry, what do you mean?
Like in terms, especially in a recession, if a newbie or some professional
Yeah.
investors, they see a really good opportunity, like in an auction or whatsoever, like you said, right?
Yeah.
But then they want to get the refinancing or they want to get the lending. It's getting very difficult. What are
Yeah.
the other suggestions you would say to get
I
around
mean,
this then?
JV, look, there's lots of people out there. Just to give you an example, in 2012 or 2009, when I started the solar company, there was lots of money floating around. There's lots of people who have cash pots, basically. One of the things that we do teach at Infinity Wealth is, being able to do JV finance. So, let's say if you found a deal, even in a market where property values are falling, lenders, don't forget, make money by lending out, right? If they're not lending anything out, they're not making any money. What you'll find is that the lenders are more prudent. So the valuations that you do have to be very, very tight.
Mm.
Yep. So it won't be a situation where you'll find and this is what I try to teach people at the moment. You should not be overstretching yourself. You should have a good credit score, right? Without a good credit score, lenders won't look at you, right? And that's the most important thing, is to have a very, very good credit score. So if you do find something, okay, the market is at the moment precarious, right? The lenders are still willing to, let's say the property was 100,000. Let's go back to 100,000, right? Instead of offering you 100,000, what they want to do is they want to safeguard themselves a little bit more. The valuers will go out and down value it. The lenders will say to the valuers, listen, I want you to be quite severe on this because we're not sure of the market. And the surveyors themselves, because they've got to come back from the lender, if they appraise the valuation too high, they could be taken to court by the lender if the lender finds out that it's actually been appraised incorrectly. So what you'll find is that they will still go out. You may think it's worth 100,000. The market may say it's 100,000, but they may offer you 95 or 90,000. But they'll still lend. It just means that you'll leave a little bit of more of your own cash into that deal.
Okay, got you. Just a quick one before we go into the next category of questions on risk. Just one thing on the Airbnb sector. I mean, do you do anything on that service accommodation, or have you kept yourself off that?
No, I've basically I don't believe in that model. I never have believed in that model. The Airbnb model. Don't forget, I am a business owner, right? As a business owner, I look to add value in properties or add value to my business. If I do Airbnb, I would be much rather better doing a hotel, buying a distressed hotel somewhere they haven't been able to make it work, and to go in there and turn around that hotel business, rather than starting Airbnbs where you've got you've got quite a small building, and that doesn't really interest me. At this moment in time, with Airbnb, I know there's lots of courses out there which I just completely disagree with, which is because of COVID-19. I know many hoteliers, okay, with having accomplished what I've accomplished, my group of friends are very, very high net worth individuals, and they also have hotels. So if you speak to them, they will tell you that, hotel bookings are down. Obviously with COVID-19, they're discounting these rooms right now. So if you've got an Airbnb, that's not to say Airbnbs don't work blanket, right? You have to be very discerning in the area that you pick your Airbnb in.
Got you.
Right? It's not a case of a blanket, Airbnb works. If you're in the correct location, so let's use an example. If you're near one of the race courses, Newmarket, Ascot, somewhere there, right? The Airbnb will work, right? But the hotels in that area obviously are going to be discounting. So can your business compete with a larger business where they can discount the rooms? And as an Airbnb, you're going to have larger void periods because the market is it's going to be more competitive. So at this moment in time, I do not feel that that model is a good model to work with. I think people are much better spending their time actually looking at properties, following their area, understanding what their area needs are, and then working out, okay, so the price trend in this particular area is rising, right? So it's to do that basically.
Okay, great stuff. Thanks for sharing that. Going on into risk and all that, of course, in trading, the financial markets and investing in the financial markets, one of the most important things is always risk, 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 risk. We always think about risk first, even before we look at the upside, because usually the upside looks after itself.
Yeah.
So we use very strict risk management rules, like drawdowns of any particular strategy before we start, like monthly drawdowns, daily drawdowns, trade to trade drawdowns. Likewise, in the property market, how do you mitigate your risk? Is it simply to see if the yield can cover the mortgage payments or the refinancing? How is it? What's the step-by-step process
Okay.
that you guys use?
Okay, so first of all, it's buying right? Most of the money in property is made at your purchase, just like in stock trading, right? It's your entry point.
Entry
So
point.
just talking to you as a trader, it's your entry point. Your entry point will determine, but whereas with stocks, they can fluctuate very quickly, right? Property will not fluctuate very quickly like that. It's actually understanding that you've bought it at the correct price. That's how you're going to protect yourself.
And
How
usually you would say 25% is for the
no,
newbie, right?
Yeah, not all. It depends on the market. So
Got you.
if we're in hypothetically 2015, 2014, I'd still be looking for BMBV deals. If I had £1 million sitting around, I would be looking for a 10%, 15% BMV deal, right? So we've got portfolios where they're not all 25% because we've got the money sitting there. We'd rather actually invest it in an asset that's generating an income. So the other way to protect yourself is also having more than one exit strategy, right? So that could be if you're looking at HMOs, or even even if you were looking at an Airbnb, if that Airbnb wasn't working out, what is the rental yield in that area? Can you turn that into an HMO? Can you use that for social housing? So just to go back to another one that we've done, when we looked at it, it was 2 flats at the time. Mortgage lenders weren't lending against it because you couldn't get a mortgage because it was 2 flats. We used our cash to buy it well below market. We then converted that. Now, that area had it wasn't a prime area, but then again, it wasn't the worst area in that location. It was a good enough area, but it was opposite the station, and London's only 45 minutes away. I also knew that I could speak to any of the London councils and we could house social housing. So I'd covered myself. I had different exit strategies always to make it work.
Okay, interesting. Yeah, very good to hear that. Quick one on that. So you gave some guidelines on for newbies, 25% for below market value, 10 to 15% usually, or sometimes if you got too much surplus cash, it's just lying around, it's not working more. Just to
then
look
work
at
on yield.
yeah.
If you've got too much cash lying, I mean, look, we discussed this before. At the moment, what is the price of money? Let me ask all the traders out there, right? What is the price of money? With all the quantitative easing going on, we are devaluing the pound, we're devaluing sterling, we're devaluing everything, right? And if you've got too much money, like Ray Dalio said, about 9 months ago, cash is trash. I don't know if you remember that. But it's more of a case of if you've got some money floating around, you always need some cash, right? But if you've got over excessive amount, you need to actually invest that into an asset. And a better way to do that is in property, where you're getting a return for that money that you're using, basically.
So, just a quick question, extension of a question on that in terms of risk is that I know most of the examples you've used residential examples. So now, would that same kind of risk principles you've talked about apply for commercial as well, or does the BMV rate come much more lower down because that highly probably you can get a good yield? How would you do that?
Well, for commercial,
Yes, that's right.
Yeah, yeah. Again, for commercial, it's very much dependent on what you're going to do with that commercial. So, there's different aspects of commercial, right? So one of the aspects of commercial is that you had the long leases, the full repair leases. These were classic ones that the banks went for, the pension funds went for, because at the end of the day, what they were doing is they were buying that commercial property really for the yield, right? So those type of buildings were maybe supermarkets. We're talking big money now, right? Supermarkets. Before, they were also buying hotels, not anymore. They were buying banks, right? So they were buying bank buildings where you had a AAA tenant in there, which you knew could service your rent payments. So again, with commercial, it depends on what you want to do with that commercial. It could be a commercial to residential. So if it's a commercial to residential, commercial valuations at the moment are on the floor. Commercial valuations really are based on square footage, right? Mm-hmm. That square footage is dropping now.
Okay.
So you would be looking at getting it at a really discounted rate per square foot, and then maybe turning that into residential where you're adding more value. So the principles that you use from residential to commercial are slightly different on the way you do the valuation. It very much depends on, I'll give you an example, right? So I helped my sister. She's got lots of money. She wanted a hands-free investment, a real true passive income. Okay. So in what I'd found for her was a co-op, a big co-op. It was, I think, about $1 million. I think the purchase price was about $1 million or just shy of $1 million, but the rental income from that was something like 70,000, right? Mm-hmm. It was on a full repair lease. So she purchased it, full repair lease. She's got the 80,000 or the 75,000 at that time coming into her. And she just wanted to be passive.
Okay, so got you.
It very much depends on how passive you want to be. Do you want to be active in property, or do you want something passive, completely passive, where commercial property can provide that, providing you pick the right ones?
Okay, great stuff. I guess it's always important, like it's just a cross-transfer principle, always to start with the end objective in mind and then work backwards to what and how you want to look at your property investments. It's a great example you shared there. Now, absolutely. Going on to this thing in you see, for example, just like COVID-19, we've experienced quite a bit in our lifetime, right? I mean, different recessions, different reasons for the recessions and all that. The last one was the Lehman Brothers, 2008. So in adverse situations like this, where global recession triggers off and tenants may not be able to pay their rent, how would property investors, you would say, is the best way to pay off their mortgages? What is the backup measures that they should have? Is it buffer cash from property yield or sell other properties? What is it?
Yeah, we don't sell stuff unless that was our game plan in the beginning, right? So when we buy something, we are not, unless it's something that we want to flip. And if it's something that we're going to buy and it is a case of buying it, high yield, it's a buy and hold strategy. To protect yourself. Now, there are going to be lots and lots of landlords out there that are not being paid by the tenant. We always keep a buffer. We've always a buffer. So I always say to people, ideally you want a 6-month buffer, right? Because if you've got void periods or if you've got periods where the tenant is not paying, you've got that surplus cash sitting there to actually carry on paying your mortgages and any other sundry things. Now, we personally keep far more than 6 months.
I see.
Because that's, we generate a lot of cash, basically.
What have you found in your experience? What kind of a buffer is really good that will help you stand through all kinds of times as a professional?
I think at a minimum you should have 6 months, right? At a minimum you should have 6 months.
Minimum.
Yeah.
Okay.
Yeah. Now that's the 6 months at least will help you. I would always say if you can do, we personally like a year. Right? Because
you like a year, okay, got you.
Like a year, right? I've always liked a year because then that way you've got it just in case. We've got a string of different types of property because we've been in the game a long time. So we've got student accommodation, we've got social housing, we've got blocks of flats rented to professionals. We've got rid of all the commercial, so we haven't got any commercial at the moment, right? But it is a case of what we're finding with the student properties, you know, the students are not paying, right? So
I
you've got
see.
a situation where the students are all strapped cash at the moment. We work with them and say, okay, well, look, let's work together. We've got that buffer as well to protect us, right?
Okay, got you.
We haven't had it because we are very mindful of putting the right tenant into our properties. So we do a lot of interviews with people who are going to rent our houses. We don't just stick them in there, basically.
Okay, good stuff. I think it's just like the principles, like I say, I mean, it's cross-transferable. I mean, what you're really suggesting here is like how you would manage any business, isn't it? I mean, you must have a buffer. And I think that's what you are suggesting here too. I think
Yeah.
it's like it's good to know the figures, like a 6-month buffer or personally 1-year buffer, and also to getting the right tenants and right from the start. I mean, interview
Yeah.
them, make sure they're the right candidates, and also in adverse situations, can they still pay, and do
Yeah.
they have enough good surplus?
Yeah. So
Um,
let me just stop you, right?
yeah,
Just give
yeah.
you a good example. Okay. So I had a tenant who gave me notice, was moving out. Now, when I buy properties, its location is always important. I had the choice of, at that time, a lot of different people. I decided to go for a nurse because a nurse is never going to be unemployed, especially with COVID-19,
Got
right?
you.
Can you see how my mind works? You know, I
Yeah, very
had other
smart.
people
Yes, very
and I
smart.
just
Yes.
said, I would much rather have a nurse. I gave her a discount and she said, look, I said, because you're helping, you know, you're helping society. She said, look, can you help me? Can you reduce the rent? I said, not a problem, right? Because I know that that person is going to be able to meet their rental demand. I'm not going to have as much grief from them and it's always going to be rented, right?
Very, very apt example. Very good. It's just, it's on the spot. You got to be spontaneous and you got to use your creativity according to
Yeah,
the
you
market
know,
conditions, isn't it?
property is about business. You are a property entrepreneur and it is a business at the end of the day. A lot of people fail to realize that property is a business and it's, you have to decide how much time you want to invest in your business. So you could have complete passive income that you're looking at, in which case you are looking at big commercial buildings, right? Commercial. So I've got friends who have got offices in central London on Tottenham Court Road, you know, and they're finding it difficult at the moment. Yeah, but that's not to say. So right now, you know, we're recommending certain products to our guys, saying, okay, if you want a passive income, you should be looking at this. Very much similar to what I did for my sister.
Okay, good stuff. You see, I mean, just like everything else, I mean, you got to see it as a business. Even in trading, you got to treat
Yeah,
it like a business. You know, you got to
yeah,
look at all your costs and revenues. Going on to the next part, this is actually quite some things that go on the internet, and I just want to just get your really brief comments on this.
mm.
You see, there's one school of thought. I don't know if you know this guy called Dave Ramsey, right? I mean, have you heard of him? Yeah,
I
I
have.
guess.
Yep,
Yeah.
yep.
So he, on one hand, is really like the minority. He would always say, you know, buy your property outright so that you always have a peace of mind in whatever situations that goes on, global recession or
Mm,
whatsoever.
mm,
Nobody can ever come hunting to you because his philosophy is if you haven't lent from someone, you're not answerable to anyone and it's yours and you
mm,
just manage it from then on. Whereas on
mm,
the other school of thoughts, which is more predominant and like yourself, they will always say, like, especially people like Grant Cardone,
mm.
you got the other extreme where he says you should never ever even own even your own property. Keep your money working harder by investing it. So what are your views on these two extremes, basically?
Yeah, well, that's quite simple to answer. Okay, I'm going to talk to you in trading terms. Okay,
Well,
you know that the current regulations, you have to be a professional trader in order to get leverage, high
yes,
leverage. Yeah.
yes, yes,
Okay, so if you've got high leverage, you can make more money. Yes or no?
yes, that's right. As long as you mitigate
Absolutely.
risk, of course.
Right.
Yeah.
So if you are an old granddad who is retiring, that's fine to buy a property outright because you don't necessarily want the headache. If you are trying to build your business and going forward, you will always use leverage. Property is, that's the other thing that people forget. Property is a leveraged business. It always is. So just like trading, where you have to mitigate your buy points or your entry points, property is the same. And that's what we teach at Infinity Wealth. It's more of a case of understanding where you can enter that particular price in the property, right? So if you've entered it right, you've got a 4-to-1 ratio of leverage. And I would say to you, leverage is always good if you want to build a portfolio. Or, if you look at the Sunday Times rich list, everyone who's on that Sunday Times rich list is leveraged. How they've made their money is leveraging, right? So it very much depends on, if you're 65, I would say, why do you need the headache of leveraging? If you've got all that money, you don't need the headache, right? If you've got millions sitting on the bank account, then that's fine. So it's again hitting that mark between the two of them, right?
Nice one, got you.
Yeah.
So in terms of, but of course in leverage, you just want to be just at least a bit aware that you're not over leveraged as well.
Yeah,
right?
correct. And that's why, we always do 75-25.
Got you.
I know that lenders now are pulling back from the 10% deposits now, because they're very scared of what the market's going to do. So there's more products out there that are 25-75.
Just one last question on this. It's like the guys like Grant Cardone online, they suggest that in terms of your own personal property, you should never even own it. You should and use that money instead to make it work harder by investing it. Shouldn't the normal person own a property in a conventional method of deposit, paying off the mortgage to finally own it, so that in their retirement age they got nothing else, the expenses have come down?
Yeah.
What do you actually think about this?
Okay, a lot of these guys. Okay, can I be totally honest with you guys? Right. A lot of these guys who say you don't have to own your own property, right?
Actually, in fact, Doctor, to be honest, I only heard Grant Cardone only actually say that.
There's lots of other people out there.
Okay,
now, what I would suggest to you is, let's say if you're 24 years old, right, or 21 or 24, you're making lots of money from trading, right? Mm-hmm. You're making lots of money from trading. At the end of the day, you have to consider, the reason why most people say that is your own house is not an asset, it's a liability. Mm-hmm. The reason why it's a liability is because you've got to make sure the roof stays as it is. If there's any repairs that need doing, you have to pay the insurance and everything else, right? That's where they're coming from. Where they're coming from is saying, well, actually, if you don't have an asset that's income generating, it's more of a liability. So it's like Robert Kiyosaki said, right? Robert Kiyosaki is another one who's also said that. And you want to generate an income from your asset. So if you've got assets floating around that are not generating your income, then it's more liability. So if you could have your own house, at the end of the day, if the roof blows off, you have to pay for that roof. Whereas if you've got a rented property, if the roof blows off, you've got all that rental income that you've had from it. Now, I personally believe that your goal should always be having a home. At the end of the day, we are human beings, we have families, and it is a case of having a house. So at some stage, you do want to have your own house. And just to give you an example, right? You could have bought a house in the 80s, right? If you speak to any of your parents, look at the valuation of that house right now. I understand that it's more of a liability, but look at the asset right now. And the other thing that you can do with that asset is, if you sell it, what I recommend to certain people is that, you could trade properties, work your way up the step ladder, right? So if you've got your own house, you've renovated it, you've added value. To give you an example, so in 1992, 93, we bought a flat. It was a 2-bedroom flat, which we got below market, because the market, if you remember, Margaret Thatcher came in and there was lots of problems and the property market was doing great. So I picked that up. It was on the market at 69,000. I picked it up at 60,000. And it was a really nice period property. We refurbished that, did it up, sold it 6 months later for 90,000. Right? Understanding what the market was doing. We then used that money to buy, and these were our own houses, right? We used that money then to buy a house around the corner, quite an affluent area. And We purchased that house again. I knew the estate agents really well. We bought that at 70. I think it was on the market for 185. We bought it for 75,000. We then worked on it for about 2 years, right? Added value to it and sold it for just shy of 500,000.
Right, got you.
I didn't pay a single bit of tax on that. Why?
No.
Because it's my own house.
Ah,
Do you understand the principle?
Yes.
So the principle is, if you want to build yourself up, you want that mansion that you've always dreamed of. That mansion that you've always dreamed of, you can actually step up to that by doing your own house, looking for things that you can add value to.
Okay, got you. Understand.
So if you're a youngster, 24, maybe you start that, you live in it, you do it up, just like I did, and then you move on to the next one, and you're going up. Yeah.
Okay, got you. Now, in terms of exit points, so in trading, like we have predetermined targets before we get into trade, or based on open equity, or we have adaptable targets according to the market conditions, according to price velocity, open equity data. There's different terminologies that we use to analyze the market to get out. So for property, do you have predefined exit points, or do you buy and hold it forever?
Right. It's based on what you want to do with that property. First and foremost, what do you want to do with that property? If that property, property is not like share trading, right? You can't just buy it and sell it. It takes a long period, right? Mm-hmm. And the market is, like I described it before, it's like an oil tanker, right? It turns very, very slowly. Whereas the share market is like a flock of birds. It will turn very quickly any direction, right? So if your main goal from that property was to flip it, then you're sticking to that flipping. Yeah, so my exit strategy was, I'm buying this and I want to flip it. So I'm flipping it. Or I'm buying this because it's a really good yield and I want to keep it because it's going to give me a passive income. Then you're holding on to it.
Start with the objective again, right, is what you're saying. So just out of interest and for other people just to, inspire and aspire to work towards, how is your portfolio divided? Is it 80% yield generating and 20% is flip based investment? How is it?
That's a good question. That's a very good question. Look, most of the time what you'll find is that most professional property investors, they have their bedrock of properties, right? Which we are not going to sell. We'll sell when we come to retire, right? A bedrock of properties which give us passive income. Then the deals that we do, either we add to them if we want, or we're just looking to flip. So the vast majority of people that I know, we're looking to actually flip all the time because we've got that passive income coming on the other side. So what we're looking for is, can we add value? Can we sell it for a higher price and make a profit? So at the moment in our portfolio, we've done developments, but we're out of all our developments, thank God, right? Okay. We're completely out of all our developments. So we are looking for developments, okay? That's not to say we're not looking, but I'm not looking to add to my buy-to-let or my HMO or commercial at the moment. I'll buy commercial to turn it into resi and flip it.
Okay, so I think assimilating that information, so the way I would look at it is, first of all, determine what should your passive income be, your net value that should be coming from the properties first, and then you work backwards and you see how many properties you need to acquire or how many properties can get you to that first.
Yes. Yeah,
and then
exactly.
once you've got that bedrock, and then you go on to the next phase, which is flipping properties and making the cash from that.
So exactly. So let's say, at the beginning, if you've got no money, it's a bit difficult. The only way you can generate money and you want to be in full-time property is to actually flip, right? And then the profit that you make from the flipping, you can then use to buy a buy-to-let or go into HMOs or things like that.
Doctor, just a quick question on that. I mean, you yourself, in your experience, how long does it take an average professional property investor to build that bedrock of properties to create a passive income?
Okay, so let's say on average, most people need about $2,000 a month, don't they?
Yeah, okay.
Right? On average, most people need some sort of income of about $2,000 a year, right? Sorry, $2,000 a month, right? So 24,000 hypothetically, right? What you'd then start off with is if you wanted to, we always like using high ROI properties. We need high cash flow. from all our property investments, right? So you can easily, if you're looking for £2,000 passive income, you can build that up within 6 months. Picking the right type of property, you can build that up within 6 months.
Okay, got you. Okay. And using the time to research and all that.
Yeah, exactly. But that won't be a standard buy-to-let, right? That would be something exotic like an HMO.
Got you. Okay, so right. So I think we go on to the last part. I'm just aware of time. Just about 9 more minutes left.
Mm-hmm.
Just a little bit out of the conventional hard figures and all that talking in terms of in trading as well. As you will appreciate, and with other investments, psychology is critical, right? I mean, keep your mind focused, always be on the present moment, looking at different opportunities, having a clear plan. Do you have any practices that you have to keep a healthy mindset that is focused and ever creative? Because you have shared some really amazing creative ideas here that you've used as well. So, is there any practices that you do?
No, I think it's just natural instinct. For me, is because I'm an entrepreneur. So for me, it's always been natural instinct. You know, there are good books that you can read, but for me, it's always just natural instinct. You know, I meditate a lot. You know, I try to keep a focus. You know, one of the things, if you ask anyone about me, is when I'm focused, I'm laser focused. So if I've got something in mind, I will just carry on doing that. Right. So for me, that's how I maintain myself, you know. You, like everyone else in life, you always have the ups and downs, but it's just keeping a calm head, really.
Got you. Yeah. Okay. Right. So I'm getting a few questions at the moment. We're going to the Q&A section.
Yeah.
Maybe before that, maybe I can just tell them, maybe also before we go into the questions and maybe time is a bit up. Also, yeah, what I want to ask was maybe they can see where they can find out more about you. Actually, that's exactly what I wanted to put into the chat box, so that they can do that as I'm answering the questions as well and reading out the questions. So I think where is it that they can find out more about you? I think you gave me your website, Infinity Wealth. Is that right?
Yeah, that's it. So if people, what I would like to offer those people that go onto our website and register today is really, you know, just the example that I've given you about, you know, but they have to be pretty honest about their financial situation. And I'd like to give them and offer them a free, consultation, if you like, on what I think would be best for them, what avenue of approach would be best for them.
Okay.
Yeah. So then, you know, if they say you have different people with different amounts of money. So, you know, what is their end goal? If their end goal is that they want to, you know, have a passive income all the time, then it's obviously a certain type of strategy. Another way would be, yeah, do you know what? I just rather have complete hands off. Then it would be a different strategy. So really trying to speak to them, saying these are the things that you should be looking at. Yeah, start looking at these sort of things. Start looking at these sort of areas, depending on how much money that they've got to spend, right, on purchasing a property.
Got you. I'm actually on your website. Can you see it? I mean, this is the place, and they just go into login or sign up. Is that right?
Yeah, that's it. So if they go into there and they sign up, then what we'll do is I will then email you guys to arrange a consultation. But when I speak to you, tell me, be honest with me. Be honest with me with your real, you know, this is what money I've got to play with. If you haven't got as much money to play with, tell me as well, because then I can create something else for you, a different type of strategy, really. So it's more of a strategy type call on where you should be going.
Okay, good stuff. Thank you so much. I mean, that's really good value for the guys in as well. Now, going on to the questions then, Doctor, I got a few questions coming in here. I think one of the things that is coming up is, what areas do you invest in for student HMOs?
Okay, that's a good question, especially with now. Now is the time to actually be very mindful of what's going on. You know, areas that we've already got as well. So, you know, we invest a lot in Stoke. We invest a lot in Northampton. We invest a lot in Kent. So we've got different areas. So it very much depends. You know, when we're looking for a student HMO, we're really looking for yields. So it is a case of, you know, what you'll find is in Liverpool or in Manchester, these are big universities. You know, Manchester's got 50,000 students. right? 50,000 students, because it's got 3 different universities there. London is a great area for a student HMOs, but the problem is the yields are rubbish. I wouldn't invest in an student HMO in London, because it's just it's not giving you the bang for your buck, basically. So I would I would definitely do your research on how good that university is, especially now, because more and more universities are actually using Zoom, and they're doing more and more online courses, right? So you've got to be mindful of what's going on. So you'll probably pick up good deals from landlords who, now are retiring, think, yeah, do you know what? I can't be bothered anymore. I'm just going to sell it. So they could be these sort of landlords around as well. I hope that answers that question.
Okay, yeah, that's good. And another one that is coming up is, how do you manage and maintain your rented property and find good quality tenants and builders?
Okay, that's good. No, that's good. Okay, so really, we've got certain areas that we've got agents that manage our portfolio, and then we manage a certain part of our own portfolio as well. So we have got an in-house team that manages our own portfolio. Some of the ones that are further away, so anything within an hour's radius from where we are, we manage it all. Anything that is further up, we are always talking to agents. So I communicate with the agents, and I've got good relationships with the agents, and they manage it, basically.
Okay, and in terms of builders and all that, Doctor, I know we've heard all kinds of stories about builders and everything. So how have you?
Yeah, builders is very difficult. One of the hardest things in property is finding a decent builder.
And also to sustain them as well, yeah. So retain them, yes.
And it's finding so the best way to do it, when I first started, bearing in mind that I already had a solar company, so I was used to dealing with tradesmen and having, and understanding what that tradesman mentality was. I went on to things like My Builder, went on to those sort of websites. I've had mixed experiences by doing that, but there's also other websites similar to that. But the main one is really from recommendations. Now,
right.
What you rely on is go to the agent, speak to the agent, see if he knows a builder, because some of these letting agents already have property management teams. So I would go to the property management teams there and find out who they can recommend.
Okay.
These are the things that I do, because I do mentoring as well. My mentoring is one-on-one, and we actually go out for 3 days in that area. In that area, we spend 3 days, speaking to builders and showing them the way on how to find the correct builder, who's good, who's bad, and we interview them. We interview letting agents. We look at the deals as well. So in person, we're there, looking at stuff basically as well. And that's how I try. I like training people like that. I don't do many a year because but I like helping people doing that basically.
Great stuff. One last question, and just aware of time, I think the one last we can squeeze in. So what is your outlook on residential property prices in London in the next year?
Right, it's pretty negative. If you look at, I haven't been able to share any of the research that I've done, but if you look at,
if you want to, Doctor, you can do it right now. You can share your screen if you want. We can just squeeze that in, maybe in the last 1-2 minutes.
Have a look. Yeah.
Let me stop my share, and if I can allow you to share too,
okay.
I think that would do it. Yes, now I think you can share.
Share. So right. Can you see that?
Yes.
Okay. So look. Let's look at how, your question was London prices, right? What I look at is, don't forget, the main differentiation between me and anyone else in the property game is that I've got a research background. I've also got a trading background, right? So I'm very, very analytical at what I do. And that's why I don't make mistakes in buying at the wrong price or anything else like that. So if you look at the house prices to earnings ratios, right? This is going back 2017. They've actually got even wider. Now, with more and more people being laid off, what you're going to find is that there's going to be more landlords that cannot meet their rental payments, basically. because they're not being paid. So over the next 6 months, 8 months, property prices in London will come down. Now, I'm going to add a slight caveat to that. Because places like Hong Kong, people want to get their money out. Because they want to get their money out, there's cash buyers out there that just gobbling stuff up as well, right? So if there's a huge influx of money coming in, then obviously, but I don't anticipate that. What I anticipate is over the next 6 months, London house prices will be coming down because incomes are dropping.
Mm-hmm. Okay. So you're expecting the price to earning ratios to come back further down again, right?
Yeah.
Okay, got you. So that's your forecast. Okay, I guess that's pretty much what we have in terms of that, in terms of our time.
Yeah.
And I think as
I'll
Dr.
just share this one again before we go. Yeah.
Okay. Yeah.
That's it. Yeah.
Yeah,
Can
that's
you see
it.
that?
Yeah. So I think we've seen it. I mean, you guys know where to go to as well. I've put the link in there for you all to get a session with Dr. Marttand. In fact, the final thing.
I hope you found it useful. I hope that they found it useful.
No, definitely. I think they can basically type into the chat box of how they found it and everything as we conclude. I think the final thing what I want to say to finally wrap up for today is that the common points what we usually keep seeing is that property and trading, I mean, we don't see it as totally like two opposing asset classes. We're seeing them actually complementing each other.
Yeah.
Exactly. The principles are cross-transferable. Thanks for sharing all that insight with us today for our traders and for also our property investors listening in through as well. So thank you so much for your time today, Doctor. It's been really very insightful. And we're already having all the comments coming in and saying that they really enjoyed it. So thank you so much once again, and thanks to everyone who have participated so far. Any last things you want to add, Doctor?
No, look, if they register, I will contact you. And I see that we haven't been able to cover a lot of questions. But if you do that, I'll arrange a call to speak to you. And the call is not timed or anything else like that. I just want to help you guys, right?
All right. Okay. Thank you so much then. Thank you, everyone. Take care.
No problem.
Bye.
Cheers. Bye.